Billionaire Carl Icahn has a warning for us all. I'm your host, Steven Van Metre, and thanks for joining me today. And this week, Carl Icahn issued a dire warning for investors, suggesting things are about to get much worse. We're going to take a look at what he said and if he's right. Let's kick this off with the headline. The start of this all is billionaire investor Carl Icahn sees a recession, or even worse, looming, and predicts a rough landing for the Fed. And I think there could be very well a recession or even worse, said the Icahn Enterprises chairman in a recent interview with CNBC. And what is a recession? Well, it refers to a period of significant economic downturn across an economy that lasts for more than a few quarters. And this can be a slump in the gross domestic product. Now, we're going to take a look at this in a moment here and see if he's right about this potential prediction. And one thing I want you to understand as we look at the next chart is when you think of GDP, it's based on output. So when you have a country who is importing more, think United States, more than it's exporting, it puts downward pressure on their GDP growth. And let's take a look because, well, as you know, imports have been surging. And here we've got the trade balance of goods and services in blue on the left and GDP on a year-over-year rate change on the right. What I want you to see is as the trade balance widens, as we import more than we export, which is showing when the blue line goes down, notice how it puts a ceiling on GDP growth and then starts to put downward pressure on it. It doesn't mean it goes negative just because we're importing more than we're exporting. It just puts downward pressure on our GDP growth. And then you can see as we entered the great financial crisis, of course, GDP growth went negative. And then look what happened after that, as we see GDP rebounding. Notice again, as imports start to rise coming out of the financial crisis, again, it starts to put pressure and flatten out the growth of our economy. And then here again, we see now coming into 2018, we had almost a soft recession, and we saw the global economy slow down. But notice how we're starting to import more than we're exporting again. I mean, we were, but we're even more importing than before. And that puts, again, downward pressure on GDP. And look now where we are at the widest in the history of our country. And of course, Carl Icahn probably right that that's going to put downward pressure on GDP growth for sure. And adding to that is, what does it have to do with consumer prices? Well, notably, when we import more, and you can see again the same blue line coming down over the same time period, and we now have the consumer price index in red, what it does is when we have cheaper foreign imports, it starts to put downward pressure on the CPI. So you see the CPI rising here, and then it comes back down because of cheaper foreign imports. And again, CPI rising, more imports coming in, prices come down. CPI rising, again, more imports, price comes down. And so a lot of people are predicting right now that prices are going to continue to spiral out of control. But due to the design of the global reserve currency, which the dollar is, it suggests that actually prices are coming down as imports go up. Let's continue on with the story with Carl, because he says, quote, "I've kept everything hedged for the last 2 years." When what he means is he's protecting against the downside. We have a strong hedge on against the long positions, and we try to be activists to get the edge. I'm negative, as you can hear. Short term, I don't even predict. And while we cannot perhaps hedge our portfolios in the same fashion Carl Icahn does, if you're concerned about any downside risk, well, be sure to check out Portfolio Shield. It is a strategy that hedges. I'll put a link up there in the corner and in the description below. You'll be glad you did. Let's continue on, because soaring inflation is another concern he has, and it was already a threat to the U.S. economy, but Russia's war has only exacerbated the outlook, he said, and he's spot on with that, because as we've looked at before, when you see spikes in the CPI, and here's 1, 2, 3, 4, 5, 6, 7, 8, 9 of them. Now, not every spike leads to recession, but you can see following big spikes in the CPI, the probabilities start to rise rapidly. And here we are looking at another one that we're about to enter recession. And the CPI has a really high correlation with crude oil. And so I'm showing you crude oil, the West Texas Intermediate, on a year-over-year rate of change. Now, notably, we can go back in time and look at periods where we can see going into the dot-com bubble, there was rising inflation and the year-over-year rate change of WTI went down, and that eventually puts downward pressure on the CPI. We see that in great financial crisis where crude oil actually crashed on a price level, and then on a year-over-year rate change, that brought inflation down. And here you can see that even though crude oil prices remain high, and the year-over-year rate change is declining, suggesting, again, that CPI is coming back down. And that will be a major issue for consumers to get that price pressure down. And there's some other evidence to suggest oil's coming down. Check this out. We see Cushing inventories this week rise for the second week, up 1.235 million barrels. Now, that may not be a big number in the history of Cushing inventories. And you're right, it's not. It's just a small amount. But check this out. We can notate when we look at Cushing inventories, which is a big factor. WTI is a big factor in gasoline production. Notice that when Cushing inventories get to a low, 2014, 2018, and now here again in 2022, you can see they tend to rise after this. And what does that mean for crude oil prices? Well, I've circled those same points. Here in mid-2014, crude oil prices go down. Mid-2018, crude oil prices go down. And now you've got 2022, where everyone thinks crude oil prices are headed higher, but likely they're actually headed lower. Now, what does that mean for the bond market as well? Well, when you see crude oil prices go down, well, I've circled roughly the same points. Here you see in 2014, you see a peak in treasury yields. They went down. Here you see in 2018, yields peak. They went down. And here now, again, just like crude oil going up, everyone thinks interest rates are also going up. But the reality is, as we see crude oil inventories build and crude oil prices come down, inflation comes down, that means interest rates are coming down as well. Now, I really don't know if they can engineer a soft landing, Icahn said about the Fed, and I'll agree with that. I think it's going to be a rough landing, and he's right. We've been talking about the yield curve over the past week. Today, we're going to look at the 530s, which is a 30-year yield minus the 5-year. And that means if you can imagine the 5-year yields being higher than 30, and we're rapidly approaching that inversion where 30-year yields are starting to come back down and 5-year yields are remaining sticky. And you can see every time you have such an inversion from the front end of the curve to the back end, the front end being 5, the 30s being the back, it is a massive indicator that a recession is imminent and lower treasury yields are coming. Inflation is a terrible thing, and when it gets going, you can't get that genie back in the bottle too easily, he said. And Icahn, you're right about that. In the last 20 to 30 years, you had cheap goods coming in from the Far East, from China for sure, and even Russia. And he thinks those days are over now, and you have this war going on, which adds another problem to your inflationary picture. Well, Carl, so far I've agreed with you, but this one, I think I'm going to disagree, and I've got some evidence to support that, because with the dollar as a global reserve currency, a rising dollar increases imports. Check this out. And here you can see with consumer prices rising, he says it's hard to get them back in the bottle. Well, we've already looked at crude oil. But how about this? When the dollar rises, it encourages, of course, inflation to come back down. And we can see periods where the dollar is rising, and we may even see inflation rising, but it starts to put a ceiling on it, and then inflation starts to come back down as the dollar gains strength. And with what's going on in the world and the Fed tightening monetary policy, well, we know the dollar is going to head higher, and that's also going to encourage not only more imports of cheaper foreign-produced goods, it's going to help contain inflation. So there we've got it. Carl Icahn, dire warning, recession imminent, and I think he's right. And with that, I'm Steve Van Metre. Thanks for being fans. Thanks for watching. Bye now. The content of this video is provided as educational and informational. It's not intended to provide investment advice. They're not to be construed as recognition or solicitation by any security, financial instrument, or participate in any particular trading strategy. This video is provided by Steve Van Metre. His own personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Advising or Steven Van Metre Financial.